8% jumping on to the second company we have. McDonald's Corporation. Now they are a multinational fast food chain founded in 1940 as a restaurant, and we can see over the last year they are up around 10% there also. Trading towards the mid to upper end of the 52-week range, a forward P of just under 25 and a forward yield of 2.28%. Now if you've been holding this company over the last 10 years, you would be up a very remarkable 209% without including those dividends. So let's take a look. The dividend safety score is sitting at 77. It looks to be safe. Market cap 2,133 billion. We're talking about a mega cap company now in terms of the key metrics. Well, they increased the dividend during the last recession above average growth and also significantly outperformed the S&P 500. With a negative 3% recession return, one of the best companies in the last recession, as it only fell by around 3%. Dividend growth, lots to love here. 99.9% increase in October of last year, 8% on average over the last 5 years, 177% over the last 20 years. So this is a very strong dividend growth company. And two things to note: they are a dividend aristocrat. They have increased those dividends for the last 25 years or more, and on top of that they are only 4 years away from becoming a dividend king. Now, dividend yield theory, we can see a sign here of reasonable valuation, 2.28% yield versus the 5-year average of 2.28. Forward P slightly under 23.9 versus 25.4. And if we compare the consumer discretionary sector, P of 14.4, McDonald's is sitting significantly higher now in terms of the free cash flow payout. Personally, remember, below 60% it is fairly inconsistent. 2022 was 76%. 2023 annual report, it hasn't been released yet, but they are expecting it to be around 62%, which is fairly positive in my opinion, as it is coming down from the previous year. In terms of the free cash flow per share, it does move in the right direction. $430 in 2013, $745 in 2022, but there are some inconsistencies and some years of stable growth. But do know 2023 is meant to be a nice year of growth to that free cash flow sales growth. Then one thing just to be aware of: we can see they have had some years of negative growth. 2021, that post-go bounce saw their top line increased 21%. 2022 was flat, but we do see 2023 expecting to be 8% growth. Always important to understand the type of companies you're investing in, whether or not they are fast growers or more mature companies numerically speaking. Then we can see that top line has decreased from 28 billion to 23 with 25 expected in 2023. They do a lot of share buybacks. They have reduced those shares outstanding from 1.01 billion to 741 million in 2022. So that is positive. They are returning excess cash to investors. ROIC, as you can see, it is typical with the companies we are running through. High figures, high percentages, 23% on return on invested capital in 2022, 25 in 2023. Very positive in my opinion. Operating margin and free cash flow margin, two things to note. First one is they are both above those minimums, and the second, whilst they are significantly above that, they seem to be increasing, which is a very strong sign of efficiency over the last few years. 30% operating margin to 46 expected in 20,123, 15 in 2013 on the free cash flow margin. 29% expected in 2023, so lots to love here with McDonald's. And then net debt to EBITDA 3.48 expected in 2023, so it is borderline a maximum, but 2024 it is expected to come down, which is a very positive sign. Now jumping into the stock valuation of McDonald's Corporation, we can jump straight in, and as always, if you do enjoy the content values being provided, smash the like button, hit that subscribe and bell button so you are continually notified of these videos as they drop, and they can be delivered to your doorstep. Margin of safety, then let's start off with 10%, and we can see McDonald's Corporation is pretty much trading at a 10% margin of safety based on our estimates and judgments. When we take a look at what Wall Street expect, well, they see the share price going up to $39 over the next 12 months, signaling a 9% upside as we're running through these stocks. Do let me know if you agree with any of these as a buy and hold in your portfolio, and whether or not you do hold these as well. Moving on to the third company, we have Visa Corporation now. This is a multinational payment card services that is headquartered in San Francisco, and we can see over the last year it is up around 18%. They're also trading towards the upper end of the 52-week range, a forward yield of 79%, with a forward P of 26.74%. Dividend safety 99, very safe, the highest score. Obtainable market cap 531 billion. A mega cap company in terms of those recess metrics. Well, they increased the dividend during the last recession and had plus 10% sales, which was above the average growth. Dividend growth, it doesn't get much better than this, a 16% increase last year, 16% on average over the last 5 years, 18% on average over the last 10 years, and they have also paid the dividend for the last 15 years, increases upon increases. Dividend yield theory, where we have a sign of undervaluation, 79 versus 67, as well as the forward P sitting lower than that 5-year average, and when we compare the sector, P financials is significantly lower at 11.1. Now free cash flow payout significantly lower than what we like to see as a maximum, 19% in 20,123, very positive. I would be shocked if we don't